Hello there, I'm Patrick Stroh, President of Rubicon M&A Insurance Services and Trusted Authority for Transactional Liability. Welcome to M&A Masters, where I speak with the leading experts in mergers and acquisitions. And we're all about one thing here, that's a clean exit for owners, founders, and their investors. I've got to say, just on a personal note real quick, when you're doing these interviews, your big dream is to go ahead and have a monster guest who's breaking some news out there. So no pressure to my guest Scott here, but this is something I'm very, very excited about today because we've got a true icon in mergers and acquisitions in America right now. Today, I'm joined by Scott Hendon, National and Global Practice Leader for Private Equity for BDO. BDO is the fifth largest accounting firm in the world that generates over $10 billion in annual revenues, has 191,000 employees working in 167 countries. So it's a special treat to have Scott here because today we're going to talk about the newly released BDO Private Capital Pulse Survey Report, which was just released. Scott, it's a pleasure to have you. Welcome to the podcast.
Thank you, Patrick. Maybe just a little bit about myself. As you said, Scott Hendon here, and I just to cover a little bit about my background. I'm originally from Lubbock, Texas. I moved to Dallas, Texas about 35 years ago. I went to Texas Tech University. I got an MS in taxation. I started my career at Arthur Andersen, and I've been with BDO for 20 years. I learned early on in my career that I wanted to get into private equity. So it didn't take a brain surgeon to figure out that there's a lot of money in motion, a lot of action. So I really wanted to get into the private equity side. And once again, I realized that there's a lot of services and a lot of value that you could add to private equity. So as you said, once again, I'm a partner at BDO, and I'm the national and global leader of the private equity practice. I'm also on the board of directors for BDO USA, and I'm also on the board of directors of BDO Capital, which is our wholly owned investment bank of BDO USA. Besides actively coordinating services and resources for our private equity clients globally, I'm also an active investor. So I also invest in private equity, I invest in pre-SPAC deals, pipes, and C rounds. So I think I have a unique perspective in that I know both the service side to the private equity funds, as well as being an investor in there.
So you've been on both ends of the table. Probably, if there are four sides to a table, you've been on all four of them.
That's right. And it's been very good to me on all sides there, Patrick. So.
Well, outstanding. So let's talk about the Private Capital Pulse Report. How did this come about? What is it about? And give me some comments before we get into details.
Sure. So first of all, we've been doing the private equity survey for over a decade. I will say that it used to be a lengthy report that we did every 12 months. And we tracked year over year what the trends were. And once again, we interviewed 200 private equity funds, 100 private equity and 100 venture capital funds. So that had been working great, and we'd been doing it for over a decade. We had a big following. It's covered by the press very well. Then we came into 2020, and we did back then we were doing one survey a year. So we did our questions in late February, early March, and then we published in early April. So as you can imagine, the change that happened between February to April in 2020, it was really, once again, a lot of the data, a lot of stuff that we're tracking, and it just wasn't relevant, right? Because obviously COVID was the thing of the hour. So we pivoted on that, and we went to more concise reports. It's our current Pulse survey, and we're doing that 2 times a year. So we do a spring and a fall. So we just released our spring, and we've done a release for fall of 2020. And I think it's a lot better. It's more concise. It covers a lot, the major issues out there. But more importantly, by doing it every 6 months, it allows us to have a better beat on fund managers. It's more frequent. We can tell what emerging trends are doing, real-time sense of what's going on. So once again, that's kind of the history of that. And once again, we get a lot of following out there. It's when we get a lot of coverage globally in regards to what's coming out of the survey.
Well, it's a good, clever name, having a private capital pulse, because if you're doing this a little bit more as real time as you can, you are on the pulse of things. So,
Yeah,
kudos to your marketing department to come up with that good title there. We can go in a lot of directions with this on this because it is a big report. But why don't we just get a little macro first? All right. What's the marketplace like for deals for private equity, specific to mergers and acquisitions?
sure. So first of all, at a high level, and then I'm going to dig down a little bit into the survey. But as we sit today, the activity is incredible. So Q1 of 2021, it's one of the best quarters that the BDO private equity practice has ever seen. So that's kind of where we're at today. Now, if you roll back to 2020, not to look back, always looking forward, but you roll back to 2020, there was $2.5 trillion of dry powder sitting there on the sidelines. Deals were frothy, and this is from January to March. Everything was going great, and pricing was good. Then COVID hits in March, and then from March to from March to June, the deals basically all got pulled back. Everything came to a screeching halt. The banks weren't loaning. The private equity funds were just trying to hunker down and figure out, how to thrive and how to be resilient during the COVID crisis. So anyway, so there's little activity from March to June. And starting in June, I think the private equity funds were getting a lot more comfortable and how to do due diligence, how to mitigate the risk.
Learned how to work Zoom.
Absolutely. So, and anyway, some of the deals started coming back. The banks started loaning again. So then you roll forward to the Q4 of 2020, and private equity is very resilient. They figured out how to adapt, and so the deal flow, all the old deals were coming back on the market that were pulled. A lot of new deals. A lot of people, because the pricing's good, I think a lot were saying, hey, are we going to have another wave of COVID? Or some were anticipating potential capital gains increases. So we just had this tremendous amount of deals come out. Plus SPACs were really getting momentum going up. They'd raised a lot of capital. So Q4 was really hot. And then we roll into Q1. And just like I said, not to be redundant, but it's been Q1 of 2021 has been extremely hot and a good time for certainly from the deal market, and a lot of activity going on there.
Is it safe to say, because we're still in the pandemic, but I'm going to call this post-pandemic right now for purposes, but would you say that activity and financial strength in this period right now, post-pandemic, has surpassed the pre-pandemic levels? Is that safe?
I would say it's right there. I will say I think one thing that came in is all the deals that got pulled and put back on, plus all the deals coming out. So it has, it certainly is right there. As far as the banks, the lending, everything's come back with a vengeance. It is amazing how resilient and resourceful that private equity has been. And I'll go into maybe a little bit later on some of the things we're seeing in the survey, but certain things have changed out there, what tailwind companies, and certainly there's new industries, a lot of digitalization, other things, but man, the market is really good. I'd say it's at as good or even better than pre-pandemic.
I would want to ask, as you get in, you could take whatever direction you want, but you had a section on there for key competitors. And one of the things I find that's very encouraging about mergers and acquisitions, just the American economy in general, is just how it is constantly expanding, it's constantly evolving. And you just look at the number of private equity firms out there. 5 years ago, there were maybe 1,000 private equity firms, or just over 1,000. There are 4,000 plus private equity firms now.
Yeah, I think it's closer to 5,000 just in the U.S.
So, let's draw from that. Let's talk about competitors in this landscape now.
You bet. So I'm looking at my survey here too, Patrick. But yeah, so the competition now. Once again, I'm going to do a comparative analysis from the fall survey to today. So once again, we polling what I'm personally seeing, I think is consistent what the fund managers feedback they gave us. Now, the number one competitor for deals, it's generally strategics and private equity are kind of one and two. That's what we generally see. Of no surprise, strategic buyers came in as what the fund managers thought in the next 6 months would be the major competitor for deals. So that came in at about 52%. It's up 3.5% over the fall survey. One thing that's really surprising is that hedge funds and mutual funds, and what the fund managers said in the survey, they said it came in the number two spot at 51% said that they would be a major competitor for deals, and that's up 12.5% since the fall survey. So I was really surprised on that. Sovereign wealth funds were in at 40.5%. It was up about 4%, and then PE and VC funds had fallen down. Usually, once again, they're one or two. For what the fund managers themselves were saying, they said that they thought the most competition, what would be coming out, and private equity and VC firms were coming in at the fourth spot or fifth spot at 36.5%. So they dropped 8.5%. So I was a little bit surprised about that. Now, we also just added SPACs, because I think if you look at the SPAC cycle, if you go back a few years, they were kind of downstream. They weren't a major player. Obviously today, the major banks, and they're raising a lot of capital. Now, they only 23.5 of them said that they saw the SPACs as a major competitor. So once again, that was a little bit lower than I thought, and we don't have any comparative analysis, but we will start tracking that for future surveys.
Yeah, let's just focus on the SPACs real quick, because the one thing about the SPAC is, for us that are in the transaction world, the A in SPAC is acquisition. And so there's no vehicle that's more ideally suited for mergers and acquisitions and for the insurance in that area than the SPACs. And while there's been legislation proposed and rule changes proposed that's really cut off the SPAC IPO activity, you still have over 400 SPACs out there looking for an acquisition in the next 2 years. And so, I agree with you. Their presence just showed up overnight, and, it's still early in the game. But I mean, what are your feelings vis-a-vis SPACs out there in the marketplace?
Yeah. So first of all, I think just what we're seeing on the survey, I think it's just the magnitude of the size. There's so much capital out there. I think SPACs, you said that it had slowed down some. Well, SPACs, you're right. There's over 430 SPACs looking for acquisitions. I think maybe 100 have been identified, but they've raised a lot of capital. Yes. and they're coming out with really good prices. And if they don't get their acquisition within a 24-month period, they have to give the capital back. So certainly you have SPACs that are out there, and I see it as a long-term too. It'll continue out there. That you were talking about the SEC came out with basically just an interpretation of how warrants should be accounted for. Mm-hmm. So you had that out there. There's quite a few restatements that are going to have to be done, but the SPAC market slowed down quite a bit, and the pipes have kind of slowed down as well. But I don't see that as a long-term effect. I think the main thing is that there's so many out there looking for deals. I think that some of the IBs once again are slowing it down. Maybe some are trying to get some people to pivot to IPOs, but they're a great vehicle and option to go public. As you said, there's a lot of advantage on there. Probably we don't have enough time on this podcast to go through, but I like it out there. I think it'll continue to be a competitor out there. I just think the 23.5%, I think the only reason it's that low is just because the magnitude of all the other players out there. But I see SPACs still being, a viable option going public. It's really, it's a lot easier to do an acquisition related than roadshow. There's, you can get 50% of your capital back. And anyway, there's a lot, generally it's faster to market than a typical IPO. So there's a lot of benefits out there. And I will say, even though they're a competitor to private equity, there also have been a really good exit strategy for private equity. So a lot of the PE-backed companies, we're seeing a lot of the funds that are wanting to ensure that their portfolio companies are ready to SPAC or go into the de-SPAC transaction. So they're definitely a competitor on one side, but a great opportunity on the other. And then we've also seen some of the private equity funds do their own SPAC raise for certain verticals out there, just because once again it's a good vehicle to raise capital and go out and do it.
And there's got to be exits for somebody, and as these portfolio companies are getting bigger and bigger, you need a bigger fish to eat this whale that you've developed, from a guppy. And so I think it's great for the M&A ecosphere that there's another place for these bigger exits to go.
Absolutely. And I will say one thing, I don't think it had a huge impact on this, but some of the funds, we had a certain number that were under, $2 billion or, of assets under management. The SPAC market obviously is the bigger deals out there too. So that might've had a little bit of impact, but I think overall the reasons it's at 23.5% is just because the size of, the $2.9 trillion of dry powder that's sitting out there.
Exactly. You mentioned the report, some key drivers for M&A. Why don't we touch on those real quick? That's more of a macro issue as well.
Sure. Yeah. So great question, Patrick. Now, what we saw in the survey for the drivers of deal flow, or what the fund managers thought would be driving it over the next 6 months. First of all, the private company sales and capital raises. So it's at 50% said that would be the major driver. It's exactly the same as the fall survey. So those are exactly the same. It's what I'd expect to see there. One thing that was a little bit surprising was succession planning. So I think a lot of them think that some of the generational companies that typically send it on to the next generation, they're going ahead to exit out. Maybe it's COVID, who knows? But anyway, whatever reason, they thought that succession planning would be one of the major drivers of deal flow coming up in the next 6 months. And it dropped from our fall, it was at 37, it went all the way up to 48%. So there's a big jump there. As far as the next one down would have been trades to other financial buyers or strategics. That came in at 46.5%. No surprises there. Investing in distressed assets was next. And that actually, we've been expecting, distressed assets to come to the market, right? Because you kind of wait for the other shoe to drop. But anyway, it actually dropped the anticipation on that 2%. But once again, for whatever reason, the banks have been, trying to work out. And anyway, we just hadn't seen, this maybe stimulus money and other things. We just hadn't seen the distressed assets on the market yet. But they listed that as number 4 out there.
That was a surprise. Yeah. The industry was preparing for a lot more distressed deals, and it didn't come around.
And you would expect eventually that'd be the case, but I think that's based on what the fund managers are seeing, or what, anyway, that was their anticipation of the market. Also on public to private transactions, or taking private transactions, 41% said they thought that would be driving deal activity. So they're looking for any public companies, even though I would say the public markets have been pretty frothy as well. But anyway, they're still looking for, key deals out there. And that was up 2%. Yeah. Corporate divestitures it's up 6.5%. And that's at approximately 38.5. And that makes perfect sense. And because a lot of the big companies out there are trying to shed non-strategic businesses.
Lean and mean,
get back to their, what they do best, and jettison out what, and have a clear focus. So anyway, they're anticipating to see a lot of divestiture transactions, and a lot of ones that can come out, build it, and build it out and flip it.
Yeah, we'll see. And the comment I had on this, the observation is from a conversation you and I had earlier, because we're both old enough to have gone through multiple cycles between, whether it's 9/11, you got the .com implosion, you had the financial crisis, and then now you got the pandemic. And in business owners that have gone through that cycle, at some point, I'm sure they're putting up their hands and they're just saying enough. Yeah. And in addition to that, you've got a situation. One thing about that didn't change in the pandemic is time didn't stop. And everybody's getting a little bit older.
Yep. And I think that has a lot to do with where they go back to succession planning, private company sales, for exactly what you said, Patrick. So agree 100% on that.
Yeah. One of the other things I found that was surprising, this is just one of those, being from California, it's a nice sounding thing, but it's now in the nomenclature in the boardrooms, and that's ESG, the environmental, social, and governance prerogatives. And the issue about that is it's ambitious and it's aspirational, and it's really good stuff out there, and everybody's got great intents, but the rules for ESG are still fluid. And if you fall short of those rules, that can have catastrophic implications. And you mentioned this, but I didn't realize this is organizations like BDO have a solution to that to keep companies abreast of that. Let's talk about ESG and then what BDO does for that, because this is a real big.
Absolutely. So first of all, in our survey, Patrick, this was the first time that we added an ESG questions. Mm-hmm. And what came back on that, our survey showed that 94% of the fund managers said that incorporating ESG investment criteria into their investment strategies was a priority to their LPs, and only 2.5% said it wasn't important. So I don't know that I'm surprised about that, but once again, it was a really large number and a very small number that said that it wasn't important to their LPs. And I think what's happening out there, one, it's going to help out on exits. I think that everybody's looking at private capital fund managers or feeling the pressure from LPs and other stakeholders to think within a sustainable investment framework. So ESG is about framing decisions to include the consideration of these risk factors, and they don't necessarily affect the financial statements directly, but it's material to the sustainable operation of the company. And then I know many are working to incorporate sustainable investment thinking into their business models, or there's also regulatory issues, Patrick. So the SEC has gotten in, they're starting to look at, certainly for public companies, but on the private equity and private capital markets, they're starting to look at the disclosures that are being made out there, and there's accountability. And then if you go overseas, certainly the regulators in the EU and some of the other places, they have pretty stringent disclosure requirements you have to do out there. As far as the services, we're working with the funds to look at how they get systems set up to track, benchmark, and see how they're doing. And there's certain metrics like RPIs or whatever that they track, and they give themselves grades, and then they're tracking, hey, how well are we doing on the various SEG components? And that's important both, for them from a business perspective to report back to the LPs. And then I think that there'll be a premium too, to the extent you have a company that's following ESG principles, that that I think the return on investment will be there as well. And certainly, I think you'll get a premium on that.
Yeah, I think it's along the book title, the infinite game. You got a long game, a short game, and then the infinite game. And this, dovetails right into that. And it's just, implementation and establishing systems. And, who better than BDO to come in and monitor and help firms adjust. So it's not one rule for everybody, but it's customized. So I think that's a tremendous value add that you have. And
we think so.
You can't have a survey like this without addressing COVID. Okay. And so, and I don't want to steal your thunder. If you want, you had your report has the sentence of this whole event, and I'll leave it to you, but talk to me about, how COVID impacted things now and going forward.
You bet. So first of all, it was in I think what you're referring to, we had that everything's changed, but nothing's different.
Yeah, everything's changed, but nothing's different. I think that's brilliant.
So let me explain that. First of all, I'm going to go through what the funds told us about, how things have, long-term impacts of COVID-19, specifically on deal making. So specifically said digital capabilities of acquisition targets, once again, a key variable in the deals. Importance of a robust risk management and acquisition targets, higher long-term ongoing valuations for certain industries, clear, robust supply chain strategies, because obviously we saw some of the weaknesses and what can happen when the supply chain breaks down, fewer in-person meetings throughout the process, lower long-term ongoing valuations for certain industries, and a shorter due diligence process. So those are the main points that came out from the survey itself, just on long-term impacts of COVID. But what do we mean by everything has changed, but nothing's different? And I'm going to throw out an analogy to you, Patrick. So if you kind of think through, think of the forest versus the trees. So if you look at the trees, there's new species that pop up, and maybe some grow faster than others. So if you throw that over to what's going on right now, some industries are faring much better. They actually thrived and grew out of COVID-19. So you have those, you have certain ways that how we work has changed. So you have a lot of these new industries. And so, from the tree perspective, we've got, new species, or, once again, companies are growing, there's been a significant change out there. On the flip side, if you look at the forest, I don't think the overall picture has really changed. So you still need to kick the tires. You still need to connect with leadership, do due diligence. You got to generate return on investment. And the major thesis is if you tend to or probably build out these portfolio companies, you'll get superior yields. And basically that's the big thing is to find quality deals. Basically do smart things, do add-ons. Hopefully you don't overpay for it. And once again, it's all about return on investment. And I think fundamentally that's what it's all about. So hence everything's changed, and that a lot of the industries and how things are done has changed, but nothing's really different in regards to private equity and how they invest and what the process is for making their investments.
Sound business practices or sound business practices, and that's not going to change. Okay, so
absolutely,
tactics might, but not overall strategy. Okay,
absolutely.
Well, now Scott, this wasn't in the report, but I do want to ask you just about because you're with private equity and throughout M&A. What COVID has taught also in the recent experience right now is having insurance on M&A transactions, specifically reps and warranties insurance, and then directors and officers tail insurance and tax policies and so forth. The early returns that we're getting on other surveys for 2021, rep and warranty is only getting stronger. It's only getting better. People are buying it more often and bigger policies. And it's because the track record has been just outstanding throughout this. And in private equity, if something doesn't work, they cut it off immediately. But, don't take my word for it. As the head, both national and global with, private equity, and they're in the business of mergers and acquisitions. What's your perspective on rep and warranty insurance? Good, bad, or indifferent?
Absolutely. Great question, Patrick. And first of all, the others besides rep and warranty, all important, but rep and warranty insurance, if you roll back 4 or 5 years, it wouldn't as common, and saw it on some of the bigger deals. I'd say today, almost all the deals, both the buy and sell side, have rep and warranty insurance. And I think that's going to continue. And the major reason that they're getting reps and warranty insurance is, first of all, from the buyer's side. Just to start out, we're generally you want to negotiate what the major terms of the deals are, price and other things. And usually the indemnification escrow, that's always not a non-productive negotiation anyway. So where you have a seller that's offering, say, a 5% indemnity escrow, but the buyer wants, what market is about 10%. So instead of having, negotiations, probably non-productive on that, bring in reps and warranty coverage, and it allows you to basically drop it down. You can drop it down to 1%, which makes the package more attractive to the seller. And then also you can negotiate, better coverage than you get out of the typical indemnification escrow. Also, it's generally a longer period where you can get a 3-year coverage period versus a 1 year. So, and then lastly, which I think is really important in, a lot of times there's going to be disputes, right? And it's a lot better if you have, especially a middle market companies, if you have the prior owners of the sellers are still coming in, they still have some rollover equity, but they're real important to the business. The last thing you want to do is having a pissing match, or sorry for the words, but basically suits or whatever the case is with prior ownership over the indemnity, versus if you have the insurance company in there. Once again, it's not the same issues, right? You can just negotiate with the insurance company about settling up on whatever the reps and warranties were. As far as the seller, it's easy because once again, they just want to get it closed as fast as possible. Reps and warranty insurance allows it to that. And if you can negotiate a 1% versus a 10%, that means that they get more of the indemnification escrow to them instead of being tied up in a low returning escrow account, so they can get more of their money and get it to work. So it's really a win-win, and it would be almost uncommon not to see it in most deals these days.
Yeah, I would, if it's done properly for the buyer, if you present the terms to the seller where you either go uninsured with a big escrow and you're at risk for a major clawback, or we're going to get this policy for you and your escrow goes from 5 or 10% transaction value down to 1%, and you can keep the rest of the money because we're not going to claw it back. 99 times out of 100, that seller not only will go that direction, but they'll happily pay all the cost. So if you're a buyer, okay, you've got all the benefits, you take all the tension out of the room, you get rid of that uncomfortable post-closing conversation saying, yeah, that escrow you wanted, yeah, we have to, we lost it. Sorry. That's all gone. Combine that it's free because the seller's going to pay for it. I mean, it's virtually bad faith on the buyer's part not to bring this up, at least be open to bring it up. What's great is rep and warranty is now available for the add-ons where you're looking at sub $50 million transactions, and those, you just pump those out. I mean, and we really appreciate it just in our industry because the claims history and the satisfaction rate on this product has never been higher. And I'm comparing that to any other insurance product out there. So we're very, very proud of it. And it's great to hear that, it's been embraced by private equity, which does not like spending a lot of money on insurance.
Yeah. But once again, for all the benefits that you just relayed and what I did, once again, it just makes sense. It gets deals done. Yeah. And also it's just a better way to get it done, get deals done, get money back to the seller, and also have proper coverage out there.
I'm curious, Scott, I know we didn't cover this earlier, but was there anything in the report that surprised you?
Some of the things that I guess that surprised me the most, well, it was just, I think we've already covered it, but when you had the mutual funds and hedge funds jumping so far up, that I was really surprised about that. I don't know exactly, we don't go back and separately interview the 200 poll participants, but that was one I just wasn't expecting. I know that they do, go out and do direct deals and some of the VC deals, but for them to be in the number 2 spot, that was really surprising for me.
Now, and again, the purpose of this is not only to take a quick snapshot back, but then using that data, looking forward. What are some of the trends based on this that we can find? What are the trends you see going forward? In a macro, micro, whichever you like. You
bet. So some of the key takeaways from there, we already talked about ESG. So obviously, I think ESG is going to continue to be more important. What we asked the funds on what they thought about asset prices, and 91% expected asset prices to rise in the next 6 months. So almost, virtually everybody thought it would raise. And there was about 50% expected to raise between 10 and 24%.
Wow. And
then you had 5.5 that actually thought it would rise more than 25%. And we're talking about a 6-month period. So that was, anyway, so I think the key takeaway there, the way things are going, with all the dry powder, the SPACs out there, prices are going to continue to go up. So it's key to kick a lot of tires and make sure you do a quality deal.
This is like real estate in California. My goodness.
But hopefully, yeah. So what happens in 2022, I guess, we'll see on that. But anyway, that was one of the big things out there. Also, the on taxation of digital services and products. So it actually came in higher than the concern about the rise in capital gains rates.
Could you clarify that taxation on digital services? So you're paying tax on SaaS kind of services?
That's correct. So it's digital products and services. And I think the reason it's going to be rising is probably twofold. That one, there's obviously a lot of stimulus money, a lot of expenses that both foreign governments as well as state governments are going to have to cover. And also, I think there's concerns with all the digitalization of products and services that, how do you keep from losing your tax base? Because a lot of it, has been typically on, you have people or you have a physical presence in a location. So there's a lot of activity going on out there from the foreign side. There's a OECD's kind of they're looking at a framework of how to tax digital services and products. They should have something coming out in the summer that'll give some guidance out there. Once again, a lot of the states are changing up their policies on how to tax digital services and products. And then lastly, I'll just mention Mexico as another key example. They just implemented a 16% VAT on digital electronic or digital services for B2B and B2C. So I think it's a big issue. Once again, I think the countries and states are going to have to continue to, figure out how they get their tax revenue and how they cover some of the cost. And just with the big changes in a digital environment, it's real important to understand what kind of impact that will have on the business, especially in technology businesses.
The innovation doesn't stop at the tax level, that's for sure. So they're gonna keep that going. We mentioned, Scott, that there are now 5,000 plus private equity firms out there. They can't all be BDO clients. So, for our members of the audience out there, if they wanted to get, not only a copy of the report, which we will have in our show notes to linked up to, but how can our audience members find you and get access to the BDO private equity services?
Well, first of all, Patrick, I would like to thank you for having me on your podcast, but everybody's free to contact me directly. My email address is shendon@bdo.com or shendon@bdo.com, or you can go to our website at www.bdo.com, click on our industry private equity, and there you'll find contact information. We do have copies of the current as well as prior surveys. We have thought leaderships, and we also have a podcast out there. You can also sign up to be notified of future surveys, thought leadership, or podcasts are coming out as well.
Well, Scott Hendon from BDO with your private equity capital pulse report for 2021. Thank you so much. It's been a real pleasure having you here today.
My pleasure. Thanks a lot, Patrick.